While the Nifty has cracked about almost 0.5% or so and now stabilizing just roughly around the 19,700 levels, it's really not that bad a start. You're not seeing a big fall really. It's a muted start at best, even for the mid and the small cap indexes, which are right now just marginally soft. Bajaj Finance, 2.5% lower as we speak right now. What is SBI Cards then up to? That stock will just come up for you on your screens next. That is down quite a fair bit. 5.5% is the fall that you're seeing on SBI Cards. Delivery, I think the block deals happened, 2.6% lower. Poonawalla FinCorp is the other one, which should come up for you on your screens next. HDFC Bank, Shriram Finance, they are the other ones. Though the street believes that they're going to be least impacted within the housing finance segment because loans under priority sector is excluded, which will not include housing. Right now, the street may be only sentimentally reacting to that and painting the entire sector with the same brush, but I think sanity will prevail eventually. So HDFC Bank, Shriram Finance, the other housing finance companies are going to be out of that gamut. What is Poonawalla FinCorp up to? We didn't check in on that stock because it's quite a deep gash that you're seeing on SBI Cards for sure. Roughly about a 4% card on Poonawalla FinCorp as well. Now let's check in on what the big banks are up to, the ones that actually led the fall yesterday. Axis, ICICI Bank, SBI will just come up for you on your screens. The weakness over there continues. In fact, quite a sharp fall for SBI. It's down over 2.5% as we speak. To the buzzing ones, what the mid-cap, or rather the IT pack is up to, considering they are the ones which are really sort of ruling the roost along with the auto pack. So Nifty IT has started off tempered, relatively better than what the rest of the market is up to. Delivery, I think that block deal has happened. The market was anticipating that SoftBank is going to be the seller and about a $150 million block is what we were anticipating. TVS Motors, after their foray into European markets, let's just check some of the newsmakers as well. JSW Steel, which has withdrawn the application for the final mine closure plan, which was submitted in early September. JSW Infra, after them getting the LOA for the Keni port in Karnataka. There's Brigade as well. They're looking to develop a land parcel with a value of about 2,100 crore rupees in Bangalore. So look out for some of these names. And MCX as well. That's been fairly buoyant of late. All the traders last night did talk about a gold move, which they believe was an aberration. MCX down about 0.5% as we speak right now. So nothing really big as such a move unless you guys are spotting something. Yeah, crude sensitive surely holding out. I can see a 2% bump up on Asian Paints.
Yeah, the only other pocket is PSU banking space because that index is down a good 2%. So PNB, SBI, in fact SBI is down 2.5%. So that heavyweight does deserve mention. And of course Bank of India, Union Bank, these are some of the other names that are in the red, but not very surprising given the news flow. But time to take the first trades from our charters then. Kunal, what's the first trade that you would be punching in?
So that would be DLF. I think the real estate pack and the rally which we've seen for the stocks has been quite strong. DLF stands to be amongst the more prominent ones from the real estate pack. Would be keen to buying the stock.
Nooresh, what are you spotting?
So that would be a buy on Dr. Reddy's. Looks promising at current levels. The risk reward is good. Expecting a move towards that 6,000 mark in the short term.
All right, let's talk about fundamentals of the market. Saurabh Mukherjea is joining us from Marcellus. Saurabh, thanks very much for your time. Good morning. Good to have you after a good Diwali break, right? And let's start our discussion with the area which you've been analyzing for a very long time. Their loan book, their evolution and their growth, Bajaj Finance. It has been in the eye of the storm, earlier with a rap on the knuckles from the RBI, and now of course the change of risk weightage due to massive growth in the personal loan side of the unsecured book. Is it a big worry? Is it digestible? How do you analyze it? And what does it do to the stock?
So look, I think I wouldn't lose too much sleep about the RBI rap on the knuckles. My reckoning is it's at the most going to impact around 2% of Bajaj Finance books, and if the Bajaj BAF management expeditiously deals with the issue, the impact on full year profit should be hopefully less than 1%. So it's a rap on the knuckles, as you say, but I'm not so sure it's that big a material impact on their FY24 profitability. I think the central bank should be lauded for trying to cool off the personal loans mania that had gripped India over the last 12 months. We were going bonkers as a country doing this personal loans business, 30-40% loan book growth in many places. We'd written a note about it for our clients around a month back saying this is getting overdone in India. Credit to Bajaj's management. BAF said in its Q2 results around 3 weeks ago that they were pulling back. They were already pulling back on personal loans. So credit to RBI. RBI's move yesterday, I reckon, will increase cost of funding for NBFCs by around 50 bips. Bajaj is well capitalized. They've raised another fresh round of capital recently, so they'll be in good shape. But I think at the system level, we should see a cool down in this personal loans mania that had gripped India. For our part, we've reduced the weight on Bajaj in our portfolio after the Q2 results. After the Q2 results, we reduced Bajaj. We increased the weight in HDFC Bank in our portfolios. In our large cap portfolio, CCP, we switched a decent amount of money from Bajaj into HDFC Bank. And we'll carry on being large Bajaj Finance shareholders. It's been one of our best performing stocks since we started Marcellus 5 years ago.
Saurabh, hi, morning. Diwali is also the time for cleanup. Any additions or deletions? I know you just talked about Bajaj Finance and HDFC Bank, but something that you may have completely exited from.
Right. So in our small cap portfolios, Little Champs, we've exited Amritanjan over the last couple of months. It's been a stock that we've held for the best part of 4 years. But post-COVID, the K-shaped recovery has meant that both their balms business and their sanitary napkins business really hasn't got going. So it's a good company. It's a 110-year-old franchise. We wish them well. And hopefully one day again, we can consider owning Amritanjan. We've built a position in Little Champs in a company called PDS. They're a sourcing platform for Western retailers like Walmart and Matalan and Primark. They help the Western retailers buy clothes in places like Bangladesh and Sri Lanka. It's been a company which has been around for a decade or so. It's after COVID that we noticed how powerful this platform is becoming as the big Western retailers switch their apparel sourcing from China to other countries like Bangladesh and Sri Lanka. PDS acts as an intermediary. We've also built a position in a company that we used to own 4 years ago called Cera Sanitary Ware. It's number two in sanitary ware in our country. It's always been a well-run business. What's been really remarkable about Cera is the working capital cycle has reduced from around 110 days 5 years ago to 70 days now, which means cash flows have jumped up. And as we get into the advanced stages of a real estate recovery, I think sanitary ware as a sector will do well, and hence Cera Sanitary Ware has become one of our new holdings in Little Champs.
Yeah, just wanted to get a sense from you on Trent as well. I see that also one of the recent additions. Not worried about the valuations at all.
Right. So in Trent's case, you got to keep in mind 3 things on the valuation. So when the market says it trades at 110 times PE, I'm always circumspect on PE. There are 3 reasons why PE in this case is relatively useless. Firstly, remember the Indas rules mean that every time you take stores on lease, you have to hit your accounting earnings, your declared earnings with an amortization hit. So it's a non-cash hit. It's not really relevant, but courtesy the accounting rules, you have to depress the published account, but it's a non-cash hit. So we adjust earnings for that. Secondly, our reading is Star Bazaar, their grocery format, is on the mend. We reckon in the next few quarters it will turn profitable. We've been visiting a lot of Star Bazaar stores over the last 6 months, and so therefore we are baking in Star Bazaar profits which are not in consensus numbers. And the third piece is on their Zudio business, which has been their big story post-COVID. We think same-store sales growth here will be considerably faster than what the rest of the market is expecting. So our reading is this company's real PE, the actual PE rather than the market, the PE that the market looks at, is somewhere around 50 times. As I've always said, when you look at franchises of this quality, 50 times PE is an attractive level for us to enter. So much like Titan 20 years ago, was basically a watches business. Over the last 20 years, it's become a jewelry business. Now increasingly it's becoming a sarees business as well, and an eyewear business. We think Trent has many more engines than the market understands it to have. And hopefully over the next 20 years, Trent will give our clients the 2000x that Triton has given in the last 20 years.
Saurabh, do you find it challenging right now to look for, pretty fairly valued ideas with, very high degree of risk reward and margin of safety? In the same breath, I'd like to talk about one area of the market which has massively underperformed last 5 years, and people have completely ignored it, don't want to touch it with a barge pole now, which is chemicals. Is there reason now to start getting constructive, even marginally, or not yet?
So look, for our style of investing, I think this is a pretty good time. Remember, we've underperformed in most of our products over the last couple of years because of our quality orientation, because of the orientations of the sorts of stocks you guys are showing on the screen. We've underperformed in most of our products over the last couple of years. Earnings growth for our companies has been around the 20% ballpark, but share price compounding for our companies over the last 2 years is basically close to zero. So you basically had earnings going up by, say, 45% cumulatively, but the share price hasn't gone up, which is why the PE has derated. The run-up in the last couple of years has been around, say, PSU stocks, metals and mining, power and infrastructure, the oil marketing companies. So the kind of lower quality names in our country have done well over the last couple of years. Our companies have taken a back seat, which is why we're finding it relatively easy actually to find high quality companies. I gave you an example of Sarah Sanitaryware. We're finding it relatively easy to find high quality companies, which we are adding to our portfolios. You'll hear about other additions over the next couple of months. On your specific point on specialty chemicals, yes, the post-COVID world, especially China returning and beginning dumping with vengeance from May this year. From May this year, China began dumping on global markets with vengeance, has hit the earnings of specialty chemicals companies, including several of our holdings such as AN Alkyl Amines. Our reading is that over the last couple of months, we haven't seen the Chinese crash prices. So from May through to September, the Chinese cut prices by around 25%. That's hit our companies. I think Alkyl Amines, for instance, have said they're considering an anti-dumping, taking China to WTO for dumping. So last 6 weeks, we haven't seen the Chinese dump. And what we are trying to figure out, Ajay, is this a good time for us to increase our positions in specialty chemicals, given that the Chinese dumping seems to have abated and the earnings have been impacted. The first half earnings for specialty chemicals companies have been impacted. We're trying to figure out, is this a good time to ramp up our positions in specialty chemicals?
Saurabh, what about real estate as a pack? I'm not sure if you have too much exposure there. Are you willing to completely be away from that theme?
Yeah, we don't buy real estate developers. Doesn't make any sense. There's too much interface with the government.
And playing it through that?
There's too much interface with the government apparatus, right? It's very difficult for real estate developers in our country to make money, given that they have to constantly interface with local government, state government, and so on.
Right. Sort of a lot of chatter in the market as well around, state elections and then, of course, the general elections as well. Is there merit in taking a tactical position? And if so, what would it be?
It's good fun to watch these things, but I'm not so sure how we can make money here. One of the most paradoxical things about these election campaigns which are underway, right, is on the one hand, we read in the newspapers every day, we hear on your channel every few weeks that unemployment is supposed to be falling in India. There's plenty of job creation. And yet every political party in all the states where campaigning is happening is basically promising cash doleouts. So money seems to be falling from the heavens as far as the political parties in our country are concerned. So clearly there is distress in the voters, in the vote banks that these parties are trying to pander to. And it's a very sort of incongruous situation. On the one hand, we are told that unemployment is crashing in our country, 10 million jobs, 15 million jobs per year are being created. But clearly in MP, Chhattisgarh, Telangana, Rajasthan, something else is happening because every political party is campaigning around how much money they will give to the poor. And I'm trying to figure out which story should I believe in. And that makes the job of trying to figure out, can you capitalize in political cycles that much harder, Aisha.
Saurabh, have you analyzed the entire wires and cable segment closely? Markets seem to have fallen in love with this segment especially the top 4-5 stocks, but at the same time, they don't come cheap, 40-50 time plus. Is it the scarcity of name just about less than 4-5 names? Would you touch it or analyze it to make it part of your portfolio
It's
going forward?
clearly an interesting sector. There used to be a time 4 or 5 years ago where it was say Havells in the north and V-Guard and Bajaj Electricals in sort of west and south, but now there are more names to consider. There's Polycab, there are RR Cables and so on. So it's an interesting space. We've looked at it. We've not been able to identify a company with strong moats, strong barriers to entry. Havells clearly is the sort of preeminent name in the space, and Anil Rai Gupta and team have done a tremendous job over the last 20 years. But we haven't been able to figure out which player to back in cables. I think it's one of those areas where perhaps we need to do more work. I think there will be long-term compounding possibilities available in cable. There's clearly moats to be built around distribution, around technology, around how you supply the channel. It's our challenge to figure out which horse to back in the cables industry.
Just going to take a leaf out of that. Saurabh, great to have you on the show, and we're going to welcome on board now Sri Gopal Kabra, the MD at RR Cable, joining in on the show right now. Mr. Kabra, great to have you on the show. Just everyone in the market is just so excited about the kind of opportunity that electricals and cables as a segment is going to throw up. Tell me, what vision do you have for your company over the next 5 years? What kind of numbers, projections, CAGR are we looking at 5 years hence?
See, basically, we have a goal of that in wire and cable segment will be growing at least for next 3-4 years, minimum 20% CAGR, and in electrical FMEG will be growing around 30% because our electrical base is a little small, and there is going to be a good demand for wire and cable industries for another like 15-20 years minimum.
Mr. Kabra, within your various segments of the business, which is the highest growing segment right now, and what do you foresee? Do you have adequate capacities for the same?
No, so we are expanding our capacity. As we mentioned that in next 1.5 years, we'll be expanding. Our capex plan is around 700 crores. And our major growth will come from cable because basically, as you know, that we as a company from wire to cable and cable to FMEG. So our cable base is very small compared to our peers because others they came from cable to wire and we are moving from wire to cable. So there is going to be much more growth in cable. Of course, wire is a core component for us. Right now, we have like 70% of our business is from wire and 30% is from cable. So definitely the cable will grow much more faster and then wire will grow.
Mm-hmm. Okay. And you think the large chunk of the revenues are going to come in from the domestic business, or do you see a bigger opportunity or, as bigger an opportunity when it comes to the exports market too?
See, both places opportunity there. Advantage in export business because our major export is to all developed world, where quality is a major concern for them and they respect for the quality and kind of approval we have. As you know that we are the only company in the world which got 35 international approval for single factory. So there we have advantage over local market. In local still there is a big challenge happening. There is a lot of quality compromising is happening in the market. But we as a RR, it's because this RR brand belongs to my name is RR is on my mother and father name. And as a company policy, we don't compromise on quality at all. So there is a challenge in local market because of quality compromises happening. Like in solar, there was a big challenge in solar wire and cable. Now, fortunately, that now government has come with the BIS approval. So we have an advantage that in solar business because we export only solar cable, we don't supply local. But now we have an opportunity because of government made a rule that they need to be BIS approval. BIS is as same as the global approval. So local market it will evolve, and like same thing is happening fire survival cable. Unfortunately, they did aluminum, but where is aluminum is not at all workable for any fire survival cable because when fires takes place, it's ambient temperature 900 degree and aluminum melt at 650. Now, so they made it again is copper. So these are the advantage. So growth will be at the same both exports and domestic almost same, so 1% plus and minus here and there.
Putting such a lot of emphasis on overseas market, and we also gather when we talk to industry guys that there is a complete overhaul of power infrastructure which is being attempted at in parts of Europe and US. The ultra high voltage segment. I mean, some of your peers also showed very good growth out there. It appears that within the wires and cable, that is turning out to be much higher. How much capacity do you have there, and are you raising capacity on that one, ultra high voltage segment?
No, see, we are not into EHV, and we don't have any plan for the next 3-4 years for coming to EHV. But our focus is into medium voltage. So right now we got capability to up to make 66 kV, and up to 122 kV we'll be making in next quarter. So we want to remain into up to medium voltage and high voltage. The extra high voltage we are not in the line. So there are very few players. Of course, I see a very bright future in EHV cable. But as a RR cable, we don't have any plan for next 3-4 years because the capex cycle and in India it's take a 5 years minimum to you have to prove your approval capacity. So it's a 5-year gestation period for anyone new player to come into EHV cable.
You know, the only one thing, sir, is that your EBIT margins have been the lowest in the domestic wire and cable segment. You know, it's less than 65% of your revenues versus your peers, you know, like a Polycab, Finolex, which are clocking around 12 to 13%. Tell me, what's the main reason for this kind of a margin performance, and when do you hope to turn around?
See, we were turning around. You must have seen my last half year result. So we are turned around and we'll be improving our margin. Basically, what happened, as you know, that we are the only company in India which is 100% REACH compliance and ROHS compliance. No one company is there. Though it's not in mandatory in India, but we believe as RR that we should give the same quality which we are giving to export market. And if you look into Europe, it's now mandatory. And in one factory, we want to maintain the same culture. See, there's going to be a big challenge for many companies, not in this wire and cable segment, but all the segments where people think that in domestic market they can play on quality. For export, they want to have a good quality. But we believe as RR that you cannot have a true culture in the company, that for domestic you have different standard and for international market different standard. So we want to maintain the global standard even for the domestic channel, number one. Number two, we had a marketing spend is little more because of our size, and the moment my size will increase and we invested heavily on future demand generation. See, we are looking for market share grabbing. So we have achieved now, gradually we'll see the improvement.
Mr. Kabra, how much improved distribution are we looking at now? Because one is expecting that you're going to widen your distribution reach, not only here, but overseas as well.
See, overseas, our entire business through distribution. We don't supply anything to projects. If you look into my last 22 years take account, we supply only distributor, and there also we have a good demand. So demand generation, we control from India, and our distributor supplies there. And we have got a very respectable brand in a few markets. And we are very much focused that our model is sustainable. We don't do white labeling. Our white labeling business is hardly 10%. And we don't have any policy of China plus or strategy. We are beginning from, we want to have a long-term sustainable model because if somebody wants RR, they will buy for RR. Even if, so that's why you see that from 2001 till today, none of the distributor left us in the global market.
Your con call, was pretty well attended, and the street was very excited after listening to your analyst con call about the kind of growth which you highlighted. In fact, Aisha and I were just discussing one very marquee and very well followed, closely followed fund manager, Mr. Prashant Jain, has bought your stock. What were the kind of most of the queries which were being posed? This was your first con call after the IPO. What were the analyst community probing you most on?
So, honestly, if you ask me, because I want to be always honest, that they were asking about the FMEG, means electrical business. They are worried, and we have committed that because this is a journey of 8 years, and next year we should be and we will be positive for electrical industry. So, cable, everyone is very confident for this kind of industries, and then only people are feared about the electrical business. So, that's where we are planning differently, and we will make it positive next year.
Right, interesting. Great to then have you on the show. Thank you so much for taking the time out and speaking with us. Answering all our questions so candidly. Good speaking with you. RR Cable, let's just see what that stock is settling in at and what is happening with the rest of the market. I can see that the impact of RBI tightening the norms on loans is clearly, some of these stocks are really feeling the heat. The PSBs are the ones which are really getting clobbered in today's trading session. There's also, of course, SBI Cards, which is now down 6.5% as we speak. RBL Bank is down 8%. There's IDFC First also, which has fallen about 4.5% as we speak. And you're not seeing any recovery come by, even in the likes of Bajaj Finance, or for that matter, some of the private banking names as well. Very quick break on that note. Come right back, lots more to talk about.
All right, let's move on and talk to Nilesh Kamli, CFO of Star Health, who's joining us on the show. Nilesh, morning. Thank you very much for your time. Ever since your con call has happened and after a very good set of earnings, everybody on the street is talking about a potential price hike, which is lurking right now. Are you considering it or may have already taken it? Can you talk to us about what is the quantum and how much is on the cards?
See, basically what we do is we monitor our products individually, and whenever a product reaches a certain loss ratio threshold, we go in for a price increase. So as we speak, there are two products where we are considering a price increase, which constitute around 13 to 15% of our portfolio. And the price increase can be anywhere between 15 to 20% range.
But Nilesh, given then the combination of volume and price impact, would you relook at your FY24 guidance by any chance? Because, the earlier guidance for the loss ratio was at about 63 to 65%.
That is what we have said. During Q2, the impact of fever and infectious disease was slightly higher than our comfort levels. We have given a guidance that the overall loss ratio might be pushed slightly higher. And we're working towards it. There was a slight higher impact of epidemic in October as well.
Mm-hmm. Okay, so what's the growth overall right now in the industry, and how much are you growing compared to the industry?
Okay. So retail health constitutes 92% of our business. So when we talk about growth, we talk about growth in retail health. Industry is growing at 18% for first half of the year, and Star Health has also grown by 18%. So we are in line with the industry growth rate.
Landscape from your peers, we understand that players like Care Health also are showing very good growth, at least the numbers are speaking of it. But again, it's a sector which is kind of from fewer larger player doing very well. So can you talk to us about some of the competitive landscape factor that you're facing?
See, as we speak, some of the players are really small. So the base is lower. Industry is growing at 18%. What we have also done is, we have tightened our underwriting practices. We have reduced our business in some of the loss ratio segments. So the growth that we are doing is by choice, and design, not by chance. So it is in line with our strategy to have good long-term profitable growth in the segment. So we are very happy with the 18% growth. In the second half, again, we are looking at a 20% growth. We have invested a lot in our digital banca channels. Banca today, we have around 44 partners. That business is growing at 50% plus. Digital business is really doing well. Today, it's growing at around 40%. So along with agency, we are focusing on banca digital channels. We are also focusing on rural business. We have opened 750 plus sales manager stations in rural parts of India. That infrastructure is also coming up really well. The idea is to open 1,000 plus branches in the rural segment. So rural digital banca, we are creating that infrastructure which will ensure that we continue to grow at 20% plus over the 3 to 5 year period.
But I just wanted to come back to the point when you talked about, the hospitalization, etc., being higher even in the month of October. So do you expect the loss ratios to continue at the higher level in Q3 as well? And also in terms of your combined ratio, it worsened to 99% in Q2, higher than the guidance that you had earlier articulated at 95%. Do you see yourself going back to that 95% level on the combined ratio?
See, the 95% guidance is for the full year. There is seasonality when it comes to loss ratio and combined ratio. Q2, there are typically higher impact of fever and infectious diseases. This was the case last year also. Last year also, the combined ratio was upwards of 98%. So Q4 is typically the best quarter where we have a lower impact of infections as well as hospitalization. So on a quarterly basis, there will be some highs and lows. What we spoke about is it was slightly higher than the level at which we are thinking about. Quarter three, as we said, we are watching it closely. We are seeing some impact reducing as we speak. But we would not like to give any guidance per se for the loss ratio for the whole year. We are in the middle of the year and we are working towards the claims ratio.
Nilesh, if composite license actually becomes a reality, do you think it will help you widen your portfolio, move towards ULIP or even term plans? How much business sense would that make for you?
Yeah. So as we speak, there is no such proposal. It was, it will take some time before it actually materializes. We believe it is at least 3 to 4 years away. But if it comes or whenever it comes, we see it as a big opportunity. It will be complementary to our existing health insurance business. We would like to increase our portfolio in the protection business because that's a natural extension of health insurance business. We are not very keen on ULIP plans or something.
Taken. So that's the latest coming in as far as Star Health is concerned as well. Thanks so much, Nilesh, for making time and speaking with us. So they're maintaining the target of 95% combined ratio, expecting a 20% growth in the second half of the year. And for now, the seasonality with respect to the hospital admissions hasn't really tapered down. So in October, it continued to be at elevated levels. The stock just around that flat line right now. Just quickly taking stock of what's happening with the rest of the banking pack as well, because from the lows of the days, there was a bit of recovery that we witnessed. Nifty is, of course, moving very close to that 19,800 mark. But if we can pull up the Nifty Bank as well to see if there's any recovery from the lows, especially when it comes to the PSU banking names and some of the NBFCs as well. So PSUs continue to languish. SBI is down around 2.5%. And just quickly wanted to mark individual names as well. SBI Card, RBL Bank, AB Capital, Poonawalla, L&T Finance Holdings, Paytm, IDFC, Chola Financials. These are your top losers, and the list is really long for all of these financials on the back foot.
Yes, they continue to be a big drag, but the point which we were discussing earlier in the day before the market opened, the lowest point of Bank Nifty got made in the first 15 minutes of trade. Even the ones where the blow is expected to be the hardest, like SBI cards, etc., have actually made a low, say 720 in the first half hour, now 735. So there is kind of buying coming in on that tip, which the possibility of which we were raising earlier in the day. So that's the market for you. Take a break, come back. A lot of interesting managements lined up, but later, here is a slice of Mark Mobius chat also, who is planning to hang his boots but was discussing market prospects in India yesterday with us.
Well, you've seen the companies that we have now, and those are the ones that we're holding on to, and they're in good shape. And I think going forward, you'll see a lot of other good companies coming in. It's really interesting that in India, the number of companies with a high return on capital is quite remarkable compared to other countries, which speaks well for the entrepreneurial spirit here in India and also the diligence of the management of companies here in India.
So the last time I remember, Mark, the list of your portfolio included APL Apollo Tubes, Metropolis, Dreamfolk, C Infosystems, Persistent. Anything that you've added, subtracted?
No, actually, the only one we've added would be Dreamfolks. As you know, if you fly at all, you know that all of the lounges are completely packed, and Dreamfolks is involved in that, but you have that on your list.
Yes, indeed. We do have that on our list among some of the others as well, including the likes of a Persistent System. So just wanted to get in your thoughts on how things have been shaping up within the IT space, because it would seem that when it comes to the earnings, a growth for some of the large cap IT names, it wasn't quite as promising. What have you made of the earnings gone by within the IT space, and what is it that you're expecting in terms of performance from IT?
Well, IT generally is going to go stronger in India because of the greater and greater need for the US and Europe and other countries around the world for diversification away from China. Of course, India already is so strong in the software business, so that will continue. But I think the hardware is where India will begin to shine. So it's going to be very interesting to see how many companies in the hardware sector, that is semiconductor hardware sector, are listed in India. Not yet, but it's going to come, and that will be very interesting.
A lot of chatter around here in India as to how, with the upcoming elections in 2024 and the currently ongoing state elections, there could be a big fillip to the capex theme. When you were last here in India in Mumbai, you must have already seen the level of infrastructure and development which is currently taking place. Just wanted to understand whether this is a theme that interests you.
Yes, but generally speaking, we found around the world, not only in India, but in other countries around the world, the construction sector is very difficult. There are lots of uneventful kind of things that take place that in the construction sector, which is not predictable, let's put it that way. So we prefer to stay away from the construction sector generally, except for companies that do supplies for the construction sector. And Apollo Tubes would be a good example of that.
The other thing, or rather the other tectonic shift which is currently taking place world over is the move towards cleaner and greener fuel. Anything within the energy transition sector within India, which is still at a very, very small and nascent stage that you like, or at least keeping your eyes closed on?
Well, as you know, the whole area of new energy, whether it be solar, whether it be wind, is growing globally and has become very diversified around the world. The problem is that with the Chinese competition driving down prices in solar and also even in wind, it's become more and more difficult for people to make a lot of money in that sector and to maintain high profitability. So you have that in addition to the fact of government regulation. When you have government regulation, of course, then you've got problems. It's nice if you want a steady dividend income, that may work, but we want growth in the actual share prices. So we prefer to stay away from this whole area of power.
Said India remains one of the top markets, one of the fastest growing economies, but the FII flows have been missing. In fact, we have been seeing consistent outflows this year. What do you think is the impediment for the foreign flows to come into India? Are there other markets which are attractive? Is valuation something that keeps them away, or they're just waiting for this election overhang to go away? Your sense?
Well, it's all about interest rates. You must remember at 5%, if somebody can put their money in the bank and get 5%, it's difficult to put more money into India or, for that matter, any other market. So there's a great sucking sound that's taking place around the world. And of course, there's also a retreat to the dollar. The US dollar is so strong against currencies around the world. But this is temporary. I don't think this will last. Interest rates will come down eventually, and you'll see money coming back in.
Also, Mark, have to get a perspective in considering the correlation of world equity markets, not just India, with what's happening with the yield. Since what you just said about, interest rates, you think 4.5 to what the US 10-year yield has now settled in at could very well be the new normal? Do you see some stability kicking in there?
I think interest rates will eventually come down along with inflation. As you know, inflation is coming down. And as I said in the past, we saw that coming because money supply has come down dramatically. So that combined with the general growth in India will mean that money will continue to come in to India. There'll be respites like we've seen recently where interest rates are too high and draw money out. But generally speaking, you'll see money come back in to India.
And in fact, Mark, wanted to get a sense from you. Globally, what's the best tactical trade right now in terms of portfolio, in terms of various asset classes, various countries? What would you call the best tactical trade right now?
Right now, of course, with the interest rates where they are now, it would be a good idea for investors to put money into the bank and get that high rate of return, but keep at least half of their assets into equities. And I always recommend that, of course, India's, in my view, the best, if not one of the best markets in which to be invested, but you have to be globally diversified. So you might want to put money into Taiwan, into other markets around the world where we see very good value.
Back with first trades right here in 80 now, and we've covered a lot of lost ground actually. Look at the Nifty intraday graph because we're back in the green, just about holding our head above water. 19,775 is where we're currently at. And, one can safely say that even the beaten down NBFC private banking law also is actually seeing a recovery. So while they still may be in the red, but they've definitely lifted off a wee bit from, those opening lows. And I can say that about IDFC First, about SBI Card, and even for that matter, and RBL. But in a mega exclusive chat, as promised, Ajay caught up with JM Financial's Vishal Kampani at the JM India conference. He spoke with us on the US economy, Indian markets, upcoming elections, financials, and a whole lot more. Let's listen in.
If you go back to last year, no one frankly expected that rates would be higher for this long. And a similar feeling was there sometime around June, July, that there will be a faster rate cut, and that did not materialize. Having said that, in the last 6 quarters or so, the US economy was still expanding, right? Despite, higher rates, you could see very strong sort of employment, and you were not seeing the consumer slowing down. But if you see the last couple of weeks, there is a very distinct feeling, and the data supporting it very strongly, that there is a slowdown which is very, very visible now. And I think that is raising hopes for a large sort of rate cut. Personally, I don't anticipate that the rate cut will be as deep and it'll be down to 200, 250 basis points. I think the revision in rates downwards will take a longer time, but I think the direction seems to be set that you won't have too many further increases. And 6 months to 9 months from now, sometime in July or August next year, there could be a very, very clear, distinct change in the talk, the body language, which is supporting the current rally that you see.
So Vishal, while in the last few quarters, I would say US struggling, many parts of Europe, we all know what's happening in China, but India has demonstrated good strength as far as the macros are concerned, economy is concerned, and even the quarter gone by, if the earnings season is any example. How are you reading the strength of the economy? You speak to the top corporates all the time, and the earnings season which went by, any sign which you picked up?
Yeah, so I think just a bit of past, I think India went through a deleveraging cycle because of ILFS, the big event, the real estate credit crisis, right? So we went through a bit of deleveraging. We went through a cleanup in terms of almost 5 lakh, 6 lakh crore of assets being sold on the wholesale side from wholesale portfolios of banks. A lot of those assets went to good corporate houses. Brownfield expansions were done, and they were very profitable assets. So India was dealing with, was having low leverage and not dealing with a leverage crisis domestically when COVID hit us. Secondly, I think the government behaved exceptionally prudently, right? They did not give any sort of freebies, right? There was literally very low error in their planning, right? Giving a guarantee scheme which never got used but gave confidence back to SMEs, right? To smaller corporates. And also India consumer leverage is very low. Secondly, India has very low external debt, right? So all of these factors push and put India into a position where I think it's one of the most attractive markets. And when you see growth at 6-7% and now at a high base, right? 10 years back, people would say, oh, India would grow at 6-7%. But 10 years back, the GDP was very different from where it is today. So I think if you ask me, the two most attractive markets in the world where any investor would allocate their capital would be the US and India, undoubtedly. Today, the way you see it. There's stability. I'm very confident that, our Prime Minister will come back even more victorious next year.
Excellent. Let's scratch that point a little more, because when we speak to a lot of market participants across the world, I was in London recently speaking with some funds, and 90% of the conversations were around political, how things can shape up. What are your thoughts on state elections? Market was jittery.
Sure.
Now they are pricing in maybe 1 or 2 states in BJP's favor. The popular narrative among the market community is that Mr. Modi will come back. But if we just analyze the work done and the momentum, What are your thoughts? You're very confident that he'll return with the thumping majority?
Yeah, I think I'm very confident, and I'm even gutsy enough to put it out that I think he'll come back with a thumping majority. I think he will do even better than what he's done in the last election. I also think that most people feel that the Indian voter is a very dumb voter. And I don't think he's really a dumb voter. He's actually a pretty smart voter. He knows what he wants locally, and he may choose what he wants locally. But he also knows that Modi is the best thing for our country today.
Is that in the price yet, stock market wise, or not yet?
No. I think he comes back with a thumping majority, and India will see the mother of all bull markets next 5 years it's ever seen.
Excellent. Let's talk about what is corporate India telling you. You are part of some of the biggest and all sectors in the boardrooms, talk and all of that. On earnings trajectory, on growth, on top line growth, what are you getting?
So today across the board, you see positive vibes from all corporates, across sectors. And see, I said this in one of my interviews a couple of years back, that India used to be a market where a few industries did well for a few years, and then it moved to other industries. And now the way we are seeing business, look at our own case, right? When I looked at my pipeline 10, 15 years back, I would tell my team, okay, this year focus on IT. Okay. Or, next 2-3 years, you're going to see great momentum in pharma, right? But today when we see every single sector, we are seeing corporates discussing growth.
The breadth of recovery, are you indicating, is very strong?
Breadth is very strong, and people feel that India really has a global position. See, if you're only relying on a part of a country or a part of a sector, a part of an economy, then you will not see breadth grow. India is really now major part of the global economy, and you're seeing that in corporate aspirations.
Fair point. Because obviously a lot of your clientele up till now were major India players.
Yeah.
But now their global play is going up.
No, absolutely correct. And it's not, we see startup companies who've successfully launched, even if they are kind of Me Too businesses in the US, they're operating those Me Too businesses at 1/10 the cost of the US in India. And they're taking those models to Southeast Asia, Middle East, Africa, so many countries, and growing.
So growth and earnings doesn't seem to be an issue at this juncture when the feedback you're getting from your corporate.
Yeah, see, I'll tell you, of course, the markets are a big fan of earnings, right?
Yes.
But markets look at earnings from a very short-term perspective. How's this quarter, next quarter, or a year and 2 years, right? Because all research reports are, focused on that quarterly earnings momentum or 2 years. But I think the real growth in India is going to come from top-line growth over the next 3 to 4 years. See, earnings can always fluctuate, right? You may have some, issues in terms of rates going up. If you're a financials company, right, rates are going up, you're going to squeeze your margins. But credit growth in the country is expanding at 15+%, and it's going to keep doing that over the next 5 years.
So that's the right way to look at growth.
Absolutely.
3 to 5 years.
I think you look at peak to peak, India has expanded very, very well. And if GDP is going to grow at 6 to 7%, good corporations will be growing their earnings in the teens over the next 5 years or 7 years. Now we look around the world, barring the US, barring India, and maybe barring some companies, say in China, right? There are very few countries that offer broad-based sectors, lots of choice, lots of breadth, many companies who are all telling you we'll be growing our revenues in the teens for the foreseeable future.
So one is good earnings and then durability and longevity of the earnings.
Absolutely. No, this is more revenues. Earnings can fluctuate, and earnings will create that volatility in the market. But if you tell me today, okay, Nifty is almost 20,000, where is Nifty going to be, say, 4 years down the line, right? So Nifty will grow. Nifty will grow. Okay, Nifty may not have performed in the last 2 years or 1 year. That could be because the earnings growth in Nifty companies could have been limited, but revenue growth is clearly visible.
Sure.
Are you seeing revenue growth slow down? No, you're not. So I think you will see that expansion with breadth. You'll see that expansion also in the core indexes.
Okay, so let's talk about, since you brought up Nifty, what are your thoughts on valuations of the market on aggregate, and maybe mid cap, small cap versus the large cap basket? The argument is mid cap is frothy, small cap is definitely frothy, large cap where the value lies. What are your thoughts on valuations?
Yeah, so I don't disagree that there are certain stocks in the small and mid cap space which would be expensive. But again, it depends on your time horizon, right? See, end of the day, when you're investing, if your time horizon is going to be 1 year, you may find things expensive. If your time horizon is 3 to 4 years, it may not be expensive, especially if you're very confident about growth. But having said that, yes, there are pockets of exuberance that we see in small and mid cap. I'm happy to say that at least we are not seeing that exuberance in the IPOs that we're doing.
Yeah.
And I think a big sort of thank you to that is actually the domestic investor community. They are being extremely disciplined. The mutual funds in India are being very disciplined. They are, really valuing things more fundamentally and not getting carried away. And therefore, we are seeing good sustainable valuations and pricing coming into the IPOs. Large caps, I don't think are overvalued. I think they're fairly valued to you, maybe even some undervalued. I think two of the best plays, for example, if one has to buy, is HDFC Bank and ICICI Bank. Simple thought, right? Just think about it. These two banks will probably compound at earnings at 15% easily over the next 5 years. And they are lending all of their loans, their yield on their loans is in single digits. So when the yield on your loans is single digits, means you have the best customer base of India.
The quality of customers is very
quality
good.
of customer is brilliant. So the chances of you having any sort of big NPA cycle is very, very low. And you're compounding earnings at 15%. If you're compounding earnings at 15%, why is a forward 20p expensive? It's not expensive.